on Sky News Business. This is Trading Day, live.
Welcome to Trading Day Live. I'm Ingrid Willinge. Of course, we're taking your calls in 60 minutes time on 1300 30 34 35. But you can get your emails in right now, yourmoney@skynews.com.au. But first up, let's take a look and see how markets are tracking today so far. Of course, up about 0.5%. We are seeing a pretty positive session today. Nice reversal, of course, from yesterday. And the reversal started, of course, on overnight trade. And some of the fears around Italy somewhat subsided. Keeping an eye on Santos as well, the company announcing a $400 million investment into its Bowen Basin Arcadia project. We're seeing that stock up about 3% right now at $5.84. Also making news this hour, China's manufacturing PMI coming in at its highest level since September of 2017. This as the country gets set for tariffs and restrictions via US President Trump. More on that, of course, in just a moment. But also a miss on the CapEx read today, coming in at 0.4% for the quarter. That was below expectations of a 1% gain that was expected. Of course, we'll have more on that. Dave DeGaris from the NAB will be joining us a little later. But joining in the studio today, it's packed up. We've got Martin Crabb from Shaw and Partners, Rudy Philippe Van Dyke from FN Arena. They'll be around, of course, in an hour to answer your calls as well. But we've also got a special welcome to Chris Conway from Australian Stock Report, who's live in the studio today. Chris, good morning to you.
Good morning.
Good afternoon, I should say. Just ticked over, of course. Well, I'll start with you, Chris, since you're in the studio today. What do you make of trade at the moment, given the fact that we've had all these macro issues, of course, in the last few sessions in particular that have sort of set a bit of fear factor through the markets? Today we've seen a rebound, though.
Yeah, sure. Look, it's certainly a nice recovery, and obviously with the problems out of Italy, I was looking back at previous events like the Brexit decision, like the election of Trump, and it seems to be a pattern where markets have sort of fallen out of bed for one or two sessions and then recovered, and that's exactly what we're seeing again now. The other thing is, I like to look at the technicals, as you know, we sort of had that dip below 6,000, we've recovered back there, so, for me as more of a technical trader, the question is, do I start buying again now?
And what's the answer to that?
Probably need a little bit more confirmation that we'll move back higher, but I think the Italy thing is a blip. It's not to say that there won't be problems further down the line, especially if a populist government does come to power. But like Brexit, we'll worry about those problems when we get there.
Yeah, Martin, how much should we be worried about what's going on in Europe? Because it's obviously not just about the Italy elections, it's about what it means for the Eurozone as a whole, because obviously Italy is one of those key three pillars, right?
Yeah,
Italy, France and Germany of the Eurozone as we know it.
Yeah, quittily, I like that. Brexit and quittily, right?
Doesn't sound as smooth as Brexit and Brexit.
Quittly's pretty cool though. Look, I think the big bear story out there, 2 or 3 years ago was a collapse of the Eurozone, right? So it wasn't just Britain leaving, it was all the peripheral countries, and once the Euro sort of implodes, which some people still think is going to happen, that's, catastrophic for global markets.
Keeps rearing its head though, doesn't it?
Yeah, that's right. So the fact that there's enough people out there that are sceptical that the Euro can actually, stay together, any sort of speed wobbles, they just use an opportunity to sort of panic people and so forth. So I think the logical kind of conclusion to all this is that it stays together, but obviously needs to work those peripheral countries a little bit harder and get their debt down and so forth. But I think it is just one of those things like geopolitical risk, things like North Korea, things like the Middle East, things like Trump versus China. They're all in the background and they bubble away and the market gets cautious about them from time to time. But the real story is just earnings growth though, Ingrid. That's the most important thing out there, is just the strength of the global economy, and the Chinese PMI again reiterated how strong the global economy is and how robust it is, and that's really what's going to drive markets more than these geopolitical things.
Yeah, we had some pretty strong German data out overnight as well in the Eurozone. But what's your take, I guess, Rudy, about what's going on overseas in the macro? We'll get to some earnings growth more locally here shortly, but in the macro, what's your take?
I see a global economy that's slowing, which might put a little bit of pressure on that whole global synchronized growth theme, in particular, though domestically, by the way. But as they always say, different views and different angles is what the market makes. And at the moment, the market is not really paying attention to any slowing that's happening out there.
Okay, and I mean, it's not just what's going on in Europe, as Martin there mentioned, it's the trade wars as well that we've got, and it does seem like we're hitting a deadline for that, and Donald Trump's come out yesterday, somewhat surprisingly reversed course on China. Actually, live now in Beijing is a Commerce Ministry press conference following comments from the US saying it has plans to press ahead with those tariffs. That's actually happening now. I think we've got some live pictures for you, but we won't take you there because I don't believe it's in English, but that's what's going on right now. And interestingly enough, Martin, and you mentioned that, is that something though, I mean, because the EU is periphery and we're sort of watching that in the background but not expecting a breakup of the Eurozone in the short term, is this something that you are watching in the short term quite closely, the trade wars, given our proximity to China?
Yeah, look, it's Absolutely. Probably the second biggest risk to markets is, some sort of extended and accelerating trade dispute between China and the US. So at the moment, it's kind of been Trump tweeting one thing and then retracting and then, attacking a company, then not attacking a company. And it's kind of hard to read actually where he's going to end up with this. He is kind of on-off with his policy, and just how China's behaved. That China's been kind of the mature one in the fight so far. Whether that continues is difficult to see, but it is one of the world's great imbalances is the US-China trade, not just trade, but also the Chinese recycling those earnings back into US treasuries and keeping the US government ticking along. So anything that upsets that equilibrium, if you like, is obviously something that's going to keep markets nervous.
Chris, do you look at a lot of the China-facing stocks in Australia? So the Treasury wines, which have obviously been in the news a lot lately, given some of the issues that potentially are around its inventories at the moment.
Yeah, I do. So A2 Milk obviously is another China-related story and a stock that I've traded and still quite like. So yeah, I do. I'm not so worried about the trade impact between Australia and China. Certainly, again, US-China, if it breaks down, it will be bad for the global economy, but it doesn't necessarily have to impact Australian companies selling into China in the same way. So I think we can look past that. I mean, the whole US-China story it's got even more elements. So, obviously China is building those islands in the South China Sea, so there's so many political angles to it as well. And we all know about Trump. He comes out hard, he negotiates, he says this is the position, and usually he rolls back a little bit to the position that he wanted to occupy all along. So, like Martin said, you wonder how much of this is posturing, how much of this is real. He says one thing, does another. And he's putting the Chinese and, unfortunately, the global economy on tilt.
So when you see, I guess, dips in markets because of this, because we've seen quite a bit of volatility on each announcement, whether it be that or whether it be other announcements from Trump, do you use those opportunities to buy?
Yeah, I do, but selectively, I guess you'd say. And when I say selectively, I mean company selectively.
Yeah, and Martin, I'll come back to you in a moment, really, but Martin, are you seeing opportunity at the moment when you see us dip below 6,000? Knowing that, you're watching the earnings growth picture in a lot of companies, you would have seen some dip maybe. Are you starting to see more opportunities?
Yeah, look, we think we're in neutral zone at the moment. I think we ran too hard. We had that big sort of run up into the middle of this month, and now we've sort of pulled back. We're sort of pulled back to fair value for being slightly overvalued in our sense. So we probably need, in terms of an asset allocation shift, we probably need to see a bit more of a pullback, and we think we're in the midst of that at the moment. So even though today we're bouncing a bit, we do think, as Rudy said, the data's rolled over somewhat. The PMI data, a lot of the employment data, the US bond market's kind of come back from 3%. So we think we're in a pullback in what is still an uptrend. So we're looking to get back on the horse, if you like, but we're probably looking for more value before we sort of pull the trigger on that.
Rudy, what do you think in terms of value in the market at the moment?
Well, I find myself always less interested in where the index is because the stocks I'm owning do not necessarily follow the index, if that makes sense. And I think, if anything, if investors have taken too much guidance from the index over the past few years, they haven't done themselves a lot of favors because this market is very polarized and very bifurcated. And on the one hand, you have the resources sector, mining and miners and the energy sector, joined, by the way, with high growth industrials. And on the other end, you have the banks and diversified financials, and they absolutely not performed. And in particular, the banks. People always say, like, oh, they haven't performed this year. They haven't performed since last year. 5 years. Yeah? 5 years. It's probably the longest streak of underperformance for the Australian banks, which represent a quarter of the index, that I remember. And I'm almost 2 decades in Australia, so it must have been a really long time.
So what does this do to your positions in the banks and I guess future positions in the banks?
Well, see, I have a different view. I mean, some people have obviously a short-term view. And I do believe that at some point, those perennial underperformers, they will bounce because you get that elastic that's being held for too long. But I still believe that the issues that are hanging over that sector, which will not go away next year, and I think people too easily, it's the same with Telstra, it's the same with AMP, it's the same with the banks, too easily think that if it's cheap today, it'll by default be a good long-term investment. I actually think it's differently. It's by default a good medium-term investment because it will bounce at some stage. Yep. But it doesn't make a good investment by default on a 3 to 5 year horizon.
Martin, I want to get your view on that, on the banks.
Yeah, it's an interesting one, isn't it? Because if you think there's any growth in the world, you'd have to say, look, you got a 7.2% fully franked yield on NAB and a bit more on Bank of Queensland, a bit less on CBA and the others.
Yep.
And you kind of go, well, they've got a 9% earnings yield, 7% fully franked yield. If there's growth in the economy, they need to retain some earnings to maintain the balance sheet and their capital ratios. If there's no growth in the economy or even negative growth in the economy, they can go to 100% payouts and then 9% fully franked yields under that scenario, which is just crazy. So you kind of think, that you're not going to be able to make that sort of money anywhere else. But at the same time, the investors are looking at it going, this Royal Commission, it's like a slow-moving train wreck. It's got another 10 months to go. And every day you watch and it's just getting worse and worse and worse. And how is the banking system going to emerge from this? It's not going to be positive, you wouldn't think.
Well, there's going to be changes and it's going to hit the regulatory
ratios. There's a lot
ratios,
of uncertainty there, Ingrid. So I think although those dividend yields look juicy and super funds be rubbing their hands at a 7% fully franked yield, the risk is that there's further downside and further capital requirements for the banking sector.
Chris, from a trading perspective, because I know obviously you're not so much long term, but from a trading perspective, how do you see the banks?
Yeah, I'm a no, as in I wouldn't buy them. Probably wouldn't sell them either because they've fallen already quite substantially. But yeah, just as Martin said, the next 10 months as we grind through this Royal Commission is going to be a horror show. So I can't see them getting a 10 or 15% bounce, which is what I would want to see if I was going to take a trade in the first place.
Speaking of the banks, the Royal Commission is taking place right now in Melbourne. Senior counsel assisting Michael Hodge is currently questioning National Australia Bank's Ross McNaughton. Let's take a little listen.
Exposure by over 1.4 million, I would have thought a good outcome for NAB.
Yes, I see that.
And you understand the property had sold for about $2.22 million.
Yes.
And there'd been about $100,000 in sale costs.
Yes.
And so roughly then this is leaving Mr. Dillon with approximately $700,000 if he's providing $1.4 million to pay down the exposure of NAB.
Yes, it would have done.
And it would seem, and I'm interested in understanding your view about this, that this is again consistent with the position that Mr. Dillon had expressed in 2010 and in 2013 and now seemingly in 2015, that he was going to retain a proportion of the funds from the sale of the property. Do you agree with that?
Yes, I agree that it's consistent that he was going to retain a portion of funds, albeit the purchase or the sales price or intended sales price and circumstances look different.
Yes, in 2010 it looked like it might be $3 million. By 2013 it looked like it might be $2.2 million or $2.3 million. It turned out to be $2.22 million.
Yes.
And what I want to understand from your perspective is what you would regard as the right approach to communicating to the customer in these circumstances where the customer is selling a property and expresses an intention as to how it is that he is going to use the funds before and during the sale process. Do you have a view about that?
Yeah, I think it's difficult where properties held as direct security and then also as support for other obligations. I think it's difficult for the bank in this instance to continually communicate what we expect from the customer should they sell the property. We'd seen in this case a number of instances where Mr. Dillon intended to sell the property, and I think it would be difficult to proactively communicate what we expected in a proposal from Mr. Dillon.
I just want to understand that because, as you know, Mr. Bassett's evidence, which he's given both in his statutory declaration and also which he discussed with you in his telephone conversation with you, was that when Mr. Dillon said whatever it is that he said about what he wanted to do with the money, that he wouldn't have said anything in response to that because he couldn't do it without credit approval. That's your understanding of what Mr. Bassett says. And do you regard that as an appropriate response from a banker of NAB to a customer in those circumstances?
I do, to the extent of not giving any commitment.
Well, ought the banker say anything about that might not happen. We might insist on all of it.
Yeah, I mean, I wouldn't have expected a banker in those circumstances to make a commitment or a statement to that effect.
You would expect the banker to just stay silent?
No, I would have expected them to be inquisitive as to what the motives behind the sale were and what the customer thought would or expected to happen.
Would you expect the banker to communicate that what was done with the proceeds would depend entirely on the agreement of the National Australia Bank?
I think that would have been. I think that would have been certainly an acceptable thing for a banker to have done. Would be to remind the customer of their obligations and what we regarded the property as security or support for.
Choosing his words carefully there, Ross McNaughton, National Australia Bank, facing the Royal Commission at the moment. We'll take you, I guess, live to that a little later. And of course, Anna Bligh is set to face the Royal Commission after the lunch break, probably after about 2 p.m. Eastern. So we'll check in with Annalise Nielsen, our reporter on the ground there as well, for a summary shortly. But Rudy, before we head to a break, I mean, in terms of the banks, there's risks obviously outside the Royal Commission. Of course, we've got risks of housing and other risks coming forward over the next 12 months.
The risks are what potentially can come as a result of the Royal Commission, which could be a credit crunch.
And are we seeing analysts sort of forecast this so far?
Yes, we are. We do. Westpac made a veiled suggestion to it in their latest update, and UBS is going very hard on the subject now for 2 or 3 weeks, forecasting that it could be orderly, but the chances are rising that it could become disorderly. And we're seeing forecasts of house price falls over the next 2 years of up to 10%. And of course, everyone can make his mind up about how that might impact on consumer sentiment, consumer spending. And UBS, for example, has already made the call that after housing, new cars will be the next one to fall off the cliff, basically.
All right, well, lots to watch, of course, when it comes to that. As I mentioned, we'll be checking in with Annalise Nielsen, who's on the ground there at the Royal Commission, our reporter covering it. We'll check in with her in about 45 minutes' time. We will take a break, but when we return, our guest host is sticking around, plus Chris Conway, as we do a bit of a deep dive on some stocks, particularly in the energy space, with some M&A taking place. Stick around. Welcome back to the program. Just some breaking news from what we've been hearing from the China Commerce Ministry, of course, talking on these US trade tariffs. And they're saying, they've been talking about the US measures against China's investments are against WTO rules. China will carefully monitor the situation and reserves the right to release countermeasures, but coming out with some softening statements as well, saying that they believe China and the US have huge potential in cooperation opportunities, hopes that the US can implement measures discussed during the Washington meeting, and also saying that when asked about the latest US trade measures against China, China's not willing to see an escalation in China-US trade frictions. And we know that wouldn't really work for both parties. So we'll watch closely how these trade wars and the rhetoric between the two plays out over coming weeks. But that is coming from the China Commerce Ministry, of course, taking place right now. Joining the studio, though, for more on all the market trade today, because we're up about 0.5% for the broader market, Martin Crabb joins us from Shaw & Partners, Rudy Philip van Dijk from FN Arena. We've also got Chris Conway from Australian Stock Report in the studio with us. And, of course, watching the sort of M&A activity in the market at the moment, Martin, I'll kick it off with you. There's been a lot of M&A activity over the past, well, you could say over the past couple of months, but probably over the first half of the year.
Yeah, it seems like it's picking up, doesn't it? So, a combination of, boards have finally got enough chutzpah after, 10 years since the GFC, and no board in the world, no matter how much you cut interest rates, was willing to borrow money and have a go at things. So I think we've sort of had that generational sort of shift where boards are kind of going, well, there's a bit of growth out there, but we're not really capturing it. Why don't we get out and swing for the fences? Credit availability, so credit spreads, despite the ructions in Italy and so forth, are still very, very low. Like Qantas is a really good example. Their credit spreads were 450 basis points 2.5 years ago. They're now 70. So Alan Joyce, if we went to a bank and wanted to buy something a couple of years ago, he'd be paying more than you and I would for a mortgage. And now he's borrowing almost at the same rate the banks do. So it's just been incredible. So there's lots of money around. Very cheap credit, and companies and boards can see growth. It's kind of everywhere, synchronised, etc. So not surprisingly, animal spirits, cheap capital and growth, these things all tend to be cyclical. So they weren't there 2, 3, 4 years ago. They are there now. And so we're starting to see people dusting off the M&A playbook.
And we'll get to Qantas shortly, but looking at that M&A, we are seeing a lot of rejections as well. I mean, we saw Santos reject Harbour Energy's bid. Chris, we also saw Healthscope reject a couple of bids at the same time as coming out with a profit warning. Is that sort of a sign of the times as well, do you think? And what do you make of the M&A, particularly in the energy space?
Yeah, so just adding to Martin's good points, one of the things that I was thinking is, boards at the moment probably have a bit of a fear of missing out. Everyone has to justify their position in this world, and if your competitor is, hoovering someone up and creating all these synergies and creating all this value and you're sitting there doing nothing, well, chances are you're not going to be around too much longer. Yeah, so I think there's a bit of that. Just to pivot away from this very slightly, it's one of the reasons why we like Link, and I know Rudy likes Link as well, is because of the corporate activity, and a company like that obviously stands to benefit. So there's just a nice little way people might play it, yeah.
Do you like Link as well, Rudy?
Yeah, but not for those reasons.
Why do you like it?
For those reasons, you should like Computershare. For the reasons why you like Link is because Link services all those funds in Australia. It's a very reliable, and that industry should consolidate in the years ahead, and that should benefit Link.
Switching gears though back to the M&A, today it's Sino Gas, and it's endorsed a $530 million takeover offer from Lone Star in the US, private equity, of course, a bid of 25 cents a share. What do you make of this, Martin? I'm not sure if you follow this stock much, but in terms of this bid, it looks like it's been endorsed by the board.
It's interesting seeing M&A in energy because, it wasn't that long ago, oil was $30 a barrel.
Yep.
And the entire US shale industry was underwater and it was going to cause a massive collapse in credit markets, etc. Fast forward 2 years and we've got people bidding $7 for Santos, and
Yep.
I'm not sure of the Sino gas thing, but we're in a world where everyone's short gas. I mean, Santos have announced an acquisition today to add to their gas reserves as well. So we've gone from being awash with energy and the Saudis and the Russians pumping as much as they can to all of a sudden we're short gas and short energy and people are buying up assets. So
Yep.
I mean, somewhere in the middle there's probably equilibrium, but if you're a holder of energy shares, you'd be loving the market at the moment.
Yeah, and part of this really comes from the growing consumption of gas in China. We're seeing a bit of a switch, obviously, as we know, from coal to help clean up the air quality there. What do you make of the energy space in the M&A and Sino as well?
I agree, and it has been true. Until a year ago, we thought we were going to face a glut in Asian gas, and China has changed that dynamic. But we should all realize the reason why the conditions today are so good for the energy sector is because they all spent too much money pre-GFC, and all that money went basically out the window. And after that, the share prices tanked, the price tanked, and shareholders went really hard on those boards, understandably so. And they all basically got into a freight, and they didn't spend anything. If anything, over the past decade, the industry has not been spending money. They've been safeguarding their dividends, which in a lot of cases had been cut as well, by the way. And the other element that is also an integral part of the energy sector is that there's an argument to be made that all the easy fields have now been discovered and being explored. So if you now go out and you spend money on drilling, you're now going to go for really difficult parts of the world, and it costs a lot of money, and it's easier to just see whatever is around who has a nice field and go have a go of that one. It's one of the reasons why there's so many shareholders in the PNG LNG project. Yeah, everyone wants to have a piece of the pie there because that is one of the most attractive fields you can think of worldwide.
Well, it's interesting because Santos obviously is a big focus now of the market, watching to see what Kevin Gallagher does next now that Harbour Energy bid was of course rejected, as Martin mentioned, as much as a $7 bid, pretty much if they did everything they said and all the caveats and hedged how Harbour wanted, but that was rejected. So now the pressure's on Santos, right, to grow.
Yeah, it is, but I love what the board did. I thought it was bold. I'm an oil bull. I think I've been on record saying I think we see an 80 price somewhere this year. So I liked it. I really liked it. It's risky, and yeah, there's a huge amount of pressure now on that board. But I think they summed it up pretty well, and they are prepared to take the risk. So yeah, I like it.
Okay, I'm interested in your oil bull story because I think you also like Qantas, don't you?
I do, yes.
How does that
Doesn't quite marry.
How does that marry?
Yeah, so there's obviously some different drivers for Qantas. Obviously, oil prices is it's about 10% of their cost structure, so it's not insignificant. Some of their book is hedged. When the hedges roll over, obviously, is important. But look, the reasons why I like Qantas is, from a trend perspective, it has done everything right recently, and that's because the business has gone from being a turnaround story to just a great company that has good revenue and earnings growth. And they're hopefully about to reinstate their dividend, which I think will change the makeup
Surprising
of...
for an airline.
Yeah, so, that I think that would be the catalyst. So I always like to see trend, and then I think catalyst, and I wouldn't be surprised to see possibly an earnings upgrade when they drop numbers in August as well.
Interesting. Okay, Martin, do you agree with that? And by the way, I should say oil prices are up overnight, so is Qantas. So let's keep that in mind. It's up 1.2%, the share price, and no real reaction to that.
Hasn't this been another amazing turnaround from a stock that nobody wanted 3 years ago as absolute dog, and massive amounts of debt and losing money, etc., etc. Alan Joyce, to his credit, has done a great job of tearing all the costs out of it and really focusing on the domestic operations. The fuel sensitivity is really not an issue. They do tend to pass that on to customers. In fact, we're still paying fuel surcharges for a whole lot of things, aren't we? So that tends to be reflected in the price of the ticket. So they're not as fuel sensitive as people think. But this has been a fantastic turnaround, and it's now in a position where it's paid down a lot of its debt, hence the reduction in its credit spreads we talked about earlier. And it's got quite a large franking balance, because back in the day it used to pay tax.
Right. So
it's got a franking credit balance, so it can start to pay pretty hefty, fully franked dividends.
Yeah. So you think they'll reinstate pretty strong dividends going forward?
Yeah, and they have to. So they've got so much cash, they're not going to buy anything you wouldn't imagine. So where does the money go? It has to go to shareholders, right?
Rudy?
What do you want me to add?
Are you in agreement, or do you have a different argument?
I think the argument is a little bit different of what made Qantas a great company today. I mean, we should all remember that the biggest enemy of shareholders is competition. And what has helped Qantas enormously is a change in the competitive landscape. And we talked about oil earlier. The fact that the oil states, the oil nations, have gone through such a tough time has meant that Qantas has been a beneficiary here. All those national airlines from the Gulf, all of a sudden they had to do a little bit less, and instead of just flying with petrodollars around, and that has helped Qantas, right? And we should all be. That shows you how those cyclical companies can make big shifts either way.
Well, it reached a fresh high today at $6.55 Qantas, but it's sitting down at $6.47 now, so it's still up 1.1%.
There's probably another element that should be added here, is that, and I thought that was quite interesting out of the presentation of Sydney airports the other day. I mean, the global population is expected to grow over the next few years. But the global number of travelers is growing much faster than the populations are. Yeah? And obviously you have not just the Qantases of this world, but you have the Sydney airports of this world and the guys in between. Yeah? The corporate travels, the Hello Worlds, everything in between. That is a very sector that's really going very, very well.
All right, we're going to speak more commodity-based in a moment, but we'll say a big thank you to Chris Conway from Australian Stock for joining us on the program today in studio. Thanks for having me. We'll take a break. When we return, though, we will talk oil in a bit more detail. Vivek Dar from CBA will be joining us next.